Hey, Rent to Retires, it's Adam Schroeder here once again with Zach Lemaster, the CEO of Rent to Retirement, and we are joined today by a special guest that is David Stockman. He is a former two-term congressman from Michigan and director of the Office of Management and Budget under President Ronald Reagan. And he is also the best-selling author of The Great Deformation, The Corruption of Capitalism in America, Trumped, A Nation on the Brink of Ruin, and How to Bring It Back, and the new book, The Great Money Bubble, Protect Yourself from the Coming Inflation Storm. David, thank you so much for joining us.
Very happy to be with you, and an inflation storm it is. So there's a lot of things to talk about in terms of what you do first to understand it, and then second to work around it. I think those are the real salient issues.
Absolutely. So let's walk through a little bit of that inflation storm. Obviously, we saw inflation skyrocket towards the Q2, Q3 of 2022. Q4, the numbers have been trailing off and coming down. So tell us a little bit about what caused the run up and what's causing the deceleration of the inflation. That's still there, mind you.
Yes. The first thing is it's not short term. Secondly, it wasn't just because gasoline and energy prices and now food prices went up, but instead, and this is what my book, The Great Money Bubble, lays out, this storm has been brewing for the last 30 years because of policies in Washington. Way too much spending, massive borrowing that was added to the public debt, and we could have maybe lived with all of that, although it was bad enough. But then the money was printed by the Fed. In other words, Washington didn't honestly finance these $1 trillion per year deficits, but it actually handed the ball to the Fed. The Fed bought up the debt, printed the money with credits snatched out of thin air. That worked its way into the financial system. We first had a great asset inflation. The stock market just soared, especially after the bottom in 2008. And eventually it worked its way through the global economy because all central banks were doing the same thing. And finally into the price of goods and services. So this is deeply embedded. It's been, as I said, brewing for years and decades. And therefore, it's not going to go away quickly. Now, people have said, well, it peaked in June. The CPI peaked in June, and it's now starting to cool down. But I think if you tell the average guy that inflation is only 7.1% year over year in November, and that's on top of months and months of rising cost of living way in excess of wage growth, it's not going to be a very satisfying reassurance. So what we need to understand here is the Fed is way behind the curve. The Fed is responsible for this inflationary storm. It is now attempting to get interest rates back into a zone of, let's say, normality or rationality. But the effect of it is going to be a severe and long-lasting recession. They can talk about a soft landing. They can talk about, how adept they are at micromanaging the economy and bringing everything to a nice, soft, happy end. But it's not going to happen. We're going to have a very, very bad recession. So people will have the worst of both worlds, what we called in the 1970s stagflation. The inflation rate isn't coming back to 2 or less anytime soon, but layoffs and job losses and shrinking GDP are going to be happening at the same time. So we need to factor all that in. We need to understand it. It's unfair. It's unfortunate. It shouldn't have happened. It could have been avoidable, but the decisions have already been made. The die has been cast, and so we now have to face down what these Washington actors have handed to us.
Well, that I think sums up our interview. Thanks so much for coming on, David. But I really want to get into, I think the next question is like, okay, sky is falling. We're in for this shit storm over the next few years that we've been, paying for. really the question is like, okay, what is it? So what does that mean though? What would you recommend to people to do with their money right now as far as like, but in first I want to say, I love your book titles. It's very rare that we get someone that have the opportunity to invest or to interview someone with like your background and accolades and stuff. So really appreciate you coming on the show and sharing your knowledge. And your book titles are very catchy. I love that.
Okay.
But what would you tell the average person? Okay, so this is where we're likely anticipating, and this is what inflation is likely going to continue at, and recession, a long and harsh recession. So I mean, what should people do right now with their money?
Well, okay, I think maybe I could answer that question by focusing on your audience, which are people that are in retirement or near retirement and trying to build their nest egg. And so real estate investors. So the real question is, for anyone in the real estate business, there is a fundamental question that needs to be asked at this juncture in time. Are you an investor for income, or are you an investor for speculation? The second point is, if you're in it for income, which is the right reason to be investing in real estate and holding the asset, whether it's in a small shopping mall or whether it's in residential properties for rent, the key thing now is to look at your rent rolls, because when the economy goes through a recession, as Warren Buffett once said, the great thing about recessions is the tide goes out and reveals who has been swimming naked. Okay, so I think the meaning of that was that as this recession comes, we will find out who can't afford to pay the rent. And if you have good, solid renters, if you have a good, solid rent roll, I think, you should be able to weather the storm. If you've got a little too much debt on the properties, now would be a good time to reduce the debt load. But if you have a solid rent roll, you should be okay. If you have fly-by-night renters, because, they were all these startups who came in and, wanted to rent 2,000 feet of office space in order to, launch the next big product of something, then I think there's going to be some real damage done in the years ahead. So again, don't speculate, invest for income. And if you're investing for income, make sure your rent rolls are as solid as possible.
So I'm hearing really from you, at least my takeaway is invest for the fundamentals of real estate. And that's why we really like middle class, B class residential housing, because people always need a place to live, regardless of what the economy is doing. And generally, those house price points or those rents are always affordable, whether it's the government subsidizing those rents or people, just paying those rents. I mean, there's always demand, need for that type of housing. Even going back to, I'm not comparing it all to 2008, but I'm just saying during that period of time, we saw your bread and butter housing perform quite well, and probably even better with higher rental demand during those times. But yeah, I think that's a great point as far as just reevaluating the portfolio, and makes me think about some of the stuff that we're looking at. We own a lot of commercial retail it's like, in this type of environment, are those retail centers going to perform well? But I know that residential real estate, just housing, and especially in inflationary environments, I view real estate and having a hard asset as a benefit or an appropriate type of investment during an inflationary period, because, I think you can play inflation into that and to your benefit. But just for the audience's sake, the last point I want to make is Adam did mention that he swims naked down in the coast. So, we'll see how this treats him. I don't know.
Yeah. David, you mentioned talking about, that 2 to 3% inflation that the Fed targets. If we're looking at a sustained period of 5-6%, what on earth are we likely to see? I mean, you worked in Washington, what they're going to be doing. Like, what on earth are they going to be doing? I mean, if 5 or 6% inflation continues over the next 5, 6, 7, 8 years.
What are they going to be doing in the Eccles building, as I call it, at the Federal Reserve? Basically, they're going to be surprising you, and they're going to be disappointing Wall Street because everybody thinks the Fed has done its job. Inflation has turned the corner. Maybe one or two more 25 basis point rate increases, and then they'll be done. And by next fall, they'll be cutting rates again in order to, re-stimulate the economy. That's the big judgment error that I think is developing today. Of course, Wall Street loves to promote that notion because people then think, well, maybe I'll buy stock now at the bottom and it's going to go up a lot by the end of next year. But that's wrong. And people who are involved in real estate or investing in real estate should be taken in by that. The Fed, whether it wants to or not, is going to have to stay at very high, much higher interest rates for far longer than anyone expects in order to get this inflation down. And I have some experience with this. I was a congressman in the late 70s, and then I became budget director in January 1981. And that was right when Volcker was wrestling the big inflation of the 1970s to the ground. And what people forget, he started raising rates the day he became Fed chairman, which was in August 1979. And he really didn't stop. He raised them dramatically and then kept them high well into 1983 and 1984. It took a long time once you have this inflation momentum in the system, which is to say prices pushing wages, wages pushing costs, cost pushing prices, and then around and around and around again. That's where we are. And so I think the Fed is going to be in an inflation fighting mode, or they're going to pause their rate increases, but not pivot and start cutting rates. I think they're going to be in that mode for several years to come. And that's going to be a big shock to the system, to the markets next year, because everybody thinks the battle has been won, and it hasn't. You can look at a lot of the internals in the inflation reports and see that outside of a few commodities, everything is still got a pretty big head of steam in terms of inflation. In the last 12 months, the year-over-year increase in grocery store prices is plus 12%. Now, that's right at the core of the CPI. That's about that's somewhere in the range of 9% of the whole CPI right there. So other than energy, which I think has now reached a new lower plateau, you have big increases, and the most important is in the whole service sector. All of these services, which are 60% of the weight in the CPI, were up by 6.8% in the last month in November. And that's the highest rate of gain in the last 40 years. So services are pushing things higher. Food is pushing things higher. Energy is not enough of a weight in the index to compensate. And so we're going to have, as I think you suggested, pretty sticky high inflation for a good period to come. And the Fed is going to be in a defensive mode, trying to wrestle it to the ground.
When it comes to the inflation that's been happening, we've seen wage growth be way higher than it was previously. People have actually been getting wages, which helps drive rent growth. Do you expect, as this goes on, for wage growth to continue, or is the wage growth going to taper off while the inflation continues and people get farther and farther behind?
Well, I think you're going to have a decent amount of wage growth until we get large increases in the unemployment rate and, the layoff rate soars. Once that happens, I think wage growth will slow down. But right now, it's going in the other direction for this reason. The labor market is still pretty tight, at least as they measure it, in part because a lot of people have just retired early or dropped out, or they're living on the welfare state one way or another.
So, David, you've given a lot of really valuable information and deep insight. I always want to tie it back to all this economic information and way of evaluating where the where we might be headed, like tie it back to real estate or tie it back to investing in general, and like look at how we apply it to our action steps that we're looking. And a lot of people, I think, would hear some of this information and say like, oh my God, this is concerning. I'm not going to do anything. Of course, we want to be conscious of like, okay, how do you strategically take this information and apply it and still be successful? And I love what you said about the, being conscious of the type of assets and the rents and investing for long-term, for income. But let's go through some of these rapid fire questions that we have prepared for you to make sure we're getting as most value out of you as we can. And then we can, if you can tie this back to real estate, please do. But we'll just kind of look for short answers on this. Okay. Who does inflation penalize the most?
I think it penalizes savers the most. It penalizes wage workers second to most, but especially wage workers that are in businesses or sectors that compete with Mexico or China or Vietnam and the rest of the low-cost world. So that's where it hurts. That's where it hits the hardest. You've seen the CPI numbers come out. A lot of people don't trust the CPI numbers. They say, oh, inflation is higher than that. People love to quote, a lot of economic people love to quote shadow stats and say it's really, 12 or 15%. Yeah. Is that true? And in your opinion, is the inflation actually what the CPI says, or is it what, some other sites are seeing? And how will people know whenever inflation actually comes back down? Well, I think the CPI is very defective in many ways, okay? And one thing they do is they adjust prices downward for what's called hedonics, quality change. And so therefore, you could go to the average guy, both of you, ask yourself, do you think that auto prices for new cars have not gone up since 1999? Do you think that? Well, according to the CPI, they haven't. Okay, because they're saying the value of the car has gone up so much from airbags and all the electronics and digitization that's on the engine and the drivetrain and so forth, that we're going to reduce the sticker price that we can see out on dealer lots for all of this hedonics. Well, people don't live on hedonics. They didn't get a boost in their paycheck because auto quality was getting better. Or the same for computers or cell phones or a lot of other things that you can think of. So yes, I think there are structures in how they calculate the CPI that cause a systematic understatement of the inflation rate. There's also a lot of guesswork in it. People think it's very scientific because we have thousands of bureaucrats at the BLS tracking all this stuff down and doing surveys every week and month. But the fact is, one of the biggest factors in the CPI, about 20% of the weight, is the so-called owner's equivalent rent, the OER in capital letters, OER. People need to look into that. That's allegedly what you are paying to rent the house that you live in and actually own. And so how do they get that answer? Well, every now and then they do a survey of consumers and say, if you were to rent your castle to somebody out on the street and move into a tent for the duration to become a landlord, what do you think you would rent it for? And they write down all those answers, they average them up, and that's how they get the OER for the CPI. Well, that is just wild guesswork, and I think it doesn't lead to an honest price for that component of the cost of living anyway. We could go on, there's substitution effects, there's a lot of things in it. So I do think CPI understates, but I don't think it does by, double. In other words, if the inflation is being reported at 7%, I don't think it's really 15%, but it could easily be low double digits. It could easily be 10%, not the 7% that we're looking at. Either way, it's bad, because when you have 7% inflation, even if it's understated, that means that in a few years, the purchasing power of your savings has dropped by, a huge percentage, and it's not good for the economy. There's there's these Keynesian economists think that inflation is some kind of wonder drug, some kind of economic wonder drug. It's not. Inflation is basically a bad thing. It leads to a lot of mistakes in the financial system and in the Main Street economy, and therefore is something that should be minimized. And it ought to be the Fed's job to get zero inflation, not to make excuses for the 7% that we have or the 2% that they're trying to target.
Yeah, I mean, cost of living just goes up way quicker than wages do.
You mentioned, last question I have for you, you mentioned that, in the 80s, Volcker raised the rates, kept them high for a long time. There is obviously the political and societal landscape has changed just a little bit since then.
Yep.
In your opinion, is there anyone out there who you've seen has the willingness and the guts to do what Volcker did, whether it's right or wrong? Is there anyone who has the willingness that you've seen to actually do something like this, or is it something we just have to cross our fingers and hope for the best?
I think, unfortunately, we have to hope for the best, because if I remember the time in the late 70s, no one really knew where Volcker was coming from either. I mean, he had been in the U.S. Treasury for some years, and then he was a banker at Chase Manhattan Bank and so forth. But sometimes the man or woman arises to the occasion. And so what we have to look for now is someone like Powell, who I didn't have a great deal of confidence in, seems to be digging in and understanding that we're in a lot deeper soup than he thought, and maybe he'll arise to the occasion. I don't say that Jay Powell is a mini Paul Volcker, but there's always the chance that he'll see what needs to be done and have the backbone and the fortitude to do what's necessary to bring the economy back to a sustainable balance. We have to hope.
All right. Well, David, thank you so much for joining us today. Again, this is David Stockman, author of the new book, The Great Money Bubble, Protect Yourself from the Coming Inflation Storm. You can find his information and everything about him. Get the book at davidstockmanscontracorner.com. That's davidstockmanscontracorner.com. The link will also be in the show notes. David, is there anything you want to leave our listeners with today? Or anything else?
Well, yes, we're in a storm, but storms end. Okay, so what you have to do is get prepared to weather the storm, just like we do when a big snowstorm is coming, and there'll be another side. There'll be a sunny day coming down the road, and then a different strategy will be called for.
All right, well, thank you so much again. And check us out at renttoretirement.com. That's renttoretirement.com. You can get those income-generating properties that David was referencing as a solid thing to do during this environment. That's renttoretirement.com. Also, don't forget to leave us a review on whatever podcast platform you utilize. And if you have any questions, send them to podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. And we'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.